Oh, hello. I didn't see you there. I'm Scott Fox, lifelong insurance nerd. Over the past few months, I've been breaking down Donald Trump's One Big Beautiful Bill, one topic at a time. How it impacts Medicare, Social Security, retirement, taxes, Medicaid, and beyond. But here's the thing. Each of those videos tells just one piece of the puzzle. So in this video, I've stitched them all together into one full-length guide, which I like to call the One Big Beautiful Bill video. That way, you don't have to jump around. You'll get the big picture from start to finish, all in one place. So grab a cup of coffee, settle in, and let's get nerdy with the complete breakdown of the One Big Beautiful Bill. Today we're kicking off a special series that might just affect every dollar in your retirement, healthcare, and estate plan. We're talking about the biggest piece of domestic legislation passed in 2025. Donald Trump's One Big Beautiful Bill. Love him or hate him, this bill is now the law. And I am not here to debate politics. This is not a partisan video. I'm not here to cheer or criticize. My job is to help people understand what laws like this mean for Medicare recipients, Social Security beneficiaries, retirees, and anyone planning ahead. So today we're going to talk a bit about who were the winners and who were the losers. This new law reshapes everything from income taxes and long-term care eligibility to estate planning and Medicare rules. It is a massive $4.5 trillion tax and spending package that was passed by the House in a tight 218 to 214 vote. Here's the big picture. Multimillionaires and investors won big. The estate tax exemption jumped to $15 million per person. The 2017 Trump tax cuts, they are now permanent. Small business owners, manufacturers, car dealers, and oil companies also winners, thanks to expanded deductions, tax breaks, and subsidies. Seniors, well, it's mixed. There are some real tax savings coming, like a higher standard deduction and some special tax breaks for U.S. citizens 65 or older. But on the flip side, Medicaid cuts and eligibility changes could hurt some folks who are depending on the state for their long-term care. Who lost the most? According to an article from Bloomberg, low-income Americans, immigrants, clean energy, elite universities, and electric vehicle makers. Awkward. If you are a retiree, or just planning to become one someday, this series is for you. I'll be walking you through how the bill affects Medicare and Medicaid, Social Security, retirement planning and tax strategy, long-term care access, estate planning and life insurance, and I will do it all without political spin. Just facts, clear explanations, and the real-world impact on your wallet. So like, subscribe, turn on notifications, and check out the next video in this series, where we dive into how this law affects your Medicare benefits. This isn't just politics, it's your future. Let's break it down together. See you in the next video, and stay nerdy, my friends. Today, we're unpacking something that could quietly reshape the future of Medicare. You may have heard that Trump's Big Beautiful Bill doesn't touch Medicare, but that's not the full story. I've spent more time than is probably healthy combing through this almost 900-page beast, and in this video, I'll walk you through what's really changing, what stays the same, and what no one else is talking about. If you rely on Medicare, or expect to, you're going to want to hear this. By the way, the link for the bill is in the description if you feel like reading it, if you're having problems sleeping. First, the good news. Medicare's eligibility age isn't changing. If you're already on Medicare or aging in soon, the benefits you've earned, Part A hospital coverage, Part B medical, even Part D drug plans, they're all still there. But here's where things get a little more complicated. One of the sections of the bill tightens Medicare enrollment rules for non-citizens. Now, technically, undocumented immigrants were never eligible for Medicare, but under previous guidance, some individuals in complex immigration situations were able to enroll temporarily. Now the law explicitly requires proof of lawful presence for continued Medicare coverage and mandates an 18-month phase-out period for anyone who no longer qualifies. Nerd tip: if you know someone who receives Medicare but isn't a citizen or green card holder, this bill could impact them. It's worth verifying their eligibility status before their coverage disappears. Let's talk about your doctors. To prevent provider shortages, the bill includes a temporary 2.5% payment boost for physicians in 2026. That may not sound like much, but in the world of Medicare reimbursement, it's a big deal. Nerd tip: doctors have been leaving the Medicare program due to low payments. This increase is meant to keep more providers in the system, especially in rural and underserved areas. Now here's something that didn't make headlines, but should have. The bill expands an existing loophole that allows pharmaceutical companies to avoid Medicare price negotiations on what's known as orphan drugs. These are medications for rare diseases. On the surface, this sounds like protecting innovation, but in practice, more drugs are being classified as orphan to sidestep price controls, even when they're used widely off-label. Nerd tip: if you take specialty medications, keep an eye on your plan's formulary during open enrollment. You could see pricing shifts, even for drugs you've been stable on for years. And finally, let's talk about long-term care. There was a staffing reform rule in motion that would have required nursing homes to meet stronger nurse-to-resident ratios. That rule is now officially on pause. The bill blocks funding for implementation until further review. That means facilities won't have to increase staffing anytime soon. Nerd tip: if you're researching nursing homes for a loved one, don't assume better staffing is coming soon. You'll need to evaluate each facility individually. Ask about nurse availability and turnover during your tour. So here's the bottom line. This bill doesn't dismantle Medicare, but it does quietly reshape who can access it, how much your doctors are paid, and how much influence Medicare has over drug pricing and care quality. None of these are headline grabbing on their own, but together they point to a shifting foundation beneath the Medicare program. In the next video, we'll cover how this bill could impact Medicaid, nursing home eligibility, and long-term care planning, especially for retirees trying to protect their assets. So if you're planning for retirement, caring for aging parents, or just trying to make sense of it all, give this video a like, subscribe, drop a comment below, and I'll see you in the next video. Stay nerdy, my friends. Oh, hello. I didn't see you there. I'm Scott Fox, lifelong insurance nerd. And if you've been counting on Medicaid to pay for your nursing home someday, we need to talk. Trump's big, beautiful bill just changed the rules, and your house just might disqualify you from coverage. In this video, we'll break down what changed, who it affects, and what you can still do to protect yourself. Starting in 2028, anyone with over $1 million in home equity, including homes with reverse mortgages and inherited property, will be denied long-term care benefits under Medicaid. So if your plan was to leave the house to your kids and rely on Medicaid, you may be out of luck. If you're middle class with a paid-off home and no long-term care plan, you're officially in the danger zone. Let's start with the big one, the home equity cap. Beginning in 2028, if your home equity exceeds $1 million, you will not qualify for Medicaid long-term care benefits. Nerd tip: home equity includes your primary residence, even if you have a reverse mortgage. It also applies to inherited property if it's in your name when you apply. This is a major change. In the past, your home was usually protected, up to a limit that varied by state. Now we've got a hard federal ceiling. And let's be real, plenty of middle-class retirees, especially in states like California or New York, are sitting on home values over $1 million, even if they're cash poor. So if your plan was to use Medicaid to pay for long-term care while leaving your house to your kids, you may need a new plan. Nerd tip: Medicaid still has a 5-year look-back period, so gifting the house now won't solve the problem. In fact, it could trigger a penalty. Now let's talk about some other changes buried in the bill that could affect your care, even if you do qualify. First, the bill bars undocumented immigrants from most Medicaid benefits, including long-term care and regular services. Emergency Medicaid is still available, but that's it. It also tightens eligibility for some legal immigrants, like certain humanitarian or parolee categories. And then there's this. The bill cracks down on provider taxes. This is a mechanism states used to draw more federal Medicaid dollars. With those loopholes closed, many states will have less money to fund Medicaid services. Nerd tip: less money at the state level could mean fewer nursing home beds, longer wait time, or stricter eligibility enforcement, even for people who qualify on paper. So what does this all mean? If you're middle class, own a home, and don't have a long-term care plan, you're now in the danger zone. You may have too much equity to qualify for Medicaid, but not enough savings to self-fund a nursing home stay. This is exactly the kind of situation that long-term care insurance, hybrid annuities, and irrevocable trust were designed for. If Medicaid is no longer a sure thing, and self-funding isn't realistic for most families, you need a plan that protects both your care and your legacy. That might mean a traditional long-term care policy that kicks in when you need care, a hybrid life and long-term care plan that returns unused premiums to your heirs, or using an irrevocable trust to shield your home and stay Medicaid eligible down the line. Nerd tip: these strategies take time to work, usually 3 to 5 years or more. So the earlier you plan, the more options you'll have. And remember, long-term care isn't just a financial issue, it's a family issue. Without a plan, your kids or spouse may end up footing the bill or making decisions in crisis mode. So take the time now to explore your options, talk with your advisor, and build a plan that protects what you've worked for. If you found this video helpful, please hit that like button, share it with a friend, and drop a comment in the comments section. I'll see you in the next video. And of course, stay nerdy, my friends. Today we're talking about something kind of rare. Good news for retirees in the tax law. Trump's big beautiful bill just made the 2017 tax cuts permanent and added new ones. While the bill wasn't great for everyone, retirees actually came out ahead. That means lower taxes on your retirement withdrawals, bigger standard deductions, and get this, seniors now get a brand new senior deduction through 2028. So what's the catch? And how do you take advantage of it? In this video, I'll break down what's changed, what's staying, and how retirees can squeeze the most out of this tax-friendly window. Let's start with the new senior deduction. If you're 65 or older, you now get an additional $6,000 deduction on top of the standard deduction through 2028. Nerd tip: married and both over 65, you could knock $12,000 off your taxable income before you even touch itemized deductions. Next, the bill keeps the 2017 tax brackets in place and makes them permanent. That means lower income tax rates for most retirees, more room in the 12% and 22% tax brackets, better Roth conversion opportunities without jumping tax tiers. Nerd tip: this could be prime time for income smoothing, shifting pre-tax IRA money into Roth IRAs over time to lower your future tax bill. Of course, you should talk to your financial advisor before making any moves. Everyone's situation is different, so think carefully before you pull the trigger. Now here's something unexpected. Tips and overtime pay are tax-free through 2028. So if you're semi-retired and still picking up part-time shifts, consulting gigs, or hospitality work, that income could be completely tax-free. Nerd tip: this also applies to some types of 1099 gig work if it's paid through tipping platforms. Check your pay stubs or apps closely. The bill also preserves the current capital gains structure, 0%, 15%, and 20% rates based on income. That's great news for retirees drawing from brokerage accounts. Nerd tip: if your taxable income stays below $48,350 for a single or $96,700 for married filing jointly, your long-term capital gains are taxed at 0% in 2025. So what's the bottom line? If you're retired or retiring soon, this law locks in a rare window of low, stable taxes through 2028. That makes it a great time to revisit your withdrawal strategy, maximize Roth conversions, explore part-time work without unexpected tax bites, and update your tax planning with your tax or financial advisor. In the next video, we'll zoom out and look at how this tax environment connects to estate planning, gifting strategies, and Social Security timing. Until then, give this video a like, drop your questions in the comments, subscribe, and as always, stay nerdy, my friends. Oh, hello. I didn't see you there. I'm Scott Fox, lifelong insurance nerd. And if you've got assets to pass on, Trump's big, beautiful bill just changed the estate planning game. Starting in 2026, the estate tax exemption triples. That means you could pass up to $15 million tax-free, or $30 million as a couple. Most families won't owe a dime in estate tax. So does that mean your life insurance policy is now pointless? Well, not quite. In this video, I'll show you what's changing, what's not, and how to rethink your legacy strategy in light of these massive tax updates. Let's start with what's actually changing. Under the new law, starting in 2026, the federal estate tax exemption increases to $15 million per person, or $30 million for a married couple. Nerd tip, that's more than triple the 2025 limit, which was set to revert to about $5.5 million per person. This change resets the estate tax landscape for the next generation. So what does that mean in plain English? Unless you've got more than $15 million in assets, or $30 million as a married couple, you won't owe federal estate taxes at all. That's a massive shift. And if you bought a large life insurance policy strictly to cover those potential estate taxes, it may be time to rethink that decision. But that doesn't mean life insurance is suddenly obsolete for estate planning. In fact, it's more versatile than ever. Here are 3 smart ways people still use life insurance in estate planning. Number 1, equalizing inheritances. Let's say one child inherits the business or the home, and the other doesn't. Life insurance can create fairness without forcing a sale of assets. Number 2, providing for a disabled child. Life insurance can fund a special needs trust, offering long-term care without jeopardizing government benefits. Number 3, tax-efficient charitable giving. You can name a charity as a beneficiary, or use life insurance to replace the value of a charitable gift for your heirs. Nerd tip, a permanent policy inside an irrevocable life insurance trust still removes the death benefit from your taxable estate, no matter how high the exemption is. Now here's something huge that didn't change. The step up in basis is still in place. That means when your heirs inherit appreciated investments like stocks, real estate, etc., they get a fresh tax basis. They won't owe capital gains taxes on your lifetime gains when they sell. Nerd tip, this one detail can be worth 6 or 7 figures in tax savings. It makes holding certain investments until death more attractive than ever. So what's the net effect of all these changes? This is a prime moment to revisit your estate plan, not just to cut unnecessary insurance or trusts, but to optimize. With higher exemptions, you may have more freedom to gift assets earlier without filing gift tax returns. Consolidate trusts or simplify your structure. Rethink who actually needs liquidity at death. And life insurance still has a role. It's just more strategic than defensive. Oh, hello. I didn't see you there. I'm Scott Fox, lifelong insurance nerd. And yes, Trump just launched a government-backed retirement account for babies? They're called Trump accounts, and they come with $1,000 automatically deposited for every child born between 2025 and 2028. But there's a twist. Shocking, right? Is this just political branding or the beginning of a new kind of Social Security? In this video, I'll break down what they are, how they work, and why they could become one of the biggest experiments in building generational wealth in the United States history. If you've got kids, grandkids, or just love nerding out about long-term tax shelters, This one's for you. Let's start with the basics. If your child is born anytime between January 1st, 2025 and December 31st, 2028, they qualify for a Trump account, and the government will deposit $1,000 automatically to get you started. Nerd tip, you don't need to apply. The account is created automatically at birth through the Social Security system and seeded by the U.S. Treasury. Once the account is opened, parents, grandparents, or even employers can contribute up to $5,000 per year per child. The funds grow tax-free, and that's a big deal. The money cannot be assessed until the child turns 18, and even then, there are some restrictions. At 18, the account converts into a kind of modified Roth IRA, with early withdrawal rules tied to education, first-time home purchases, or starting a business. Full penalty-free withdrawals become available starting around age 30. And here's where it gets interesting. The money must be invested in low-cost index funds. No stock picking, no crypto, no meme stocks. Nerd tip. The bill caps expense ratios at 0.1% and uses a government-managed investment window similar to the federal thrift savings plan. That keeps costs low and growth consistent, so the account works more like a slow-burning engine than a speculative rocket. So how does this compare to a 529 plan or a traditional Roth IRA? Well, it's not either, really. A 529 is strictly for education. A Roth IRA usually requires earned income. Trump accounts are automatic, tax-free, and designed for long-term financial flexibility. In other words, it's a hybrid savings tool. Part education fund, part retirement fund, part business startup fund. Nerd tip. If you already contribute to a 529 or custodial Roth IRA, a Trump account could complement, not replace, those strategies. Now, are these accounts perfect? Not quite. Critics argue that $1,000 isn't enough to make a meaningful difference unless parents are able to make consistent annual contributions. And of course, it's still unclear how future administrations will treat these accounts. Will they expand the program or just sort of quietly defund it? But here's the big picture. This is the first time we have seen a universal government-seeded long-term investment account tied to birth. If you're a parent or grandparent thinking generationally, this is a tool worth watching. And who knows, if the program sticks, for better or for worse, it may lay the groundwork for major Social Security reform in the future. What do you think? Would you open a Trump account for your kids or grandkids? Let me know in the comments. And if you like this video, please give it a like and share it with your friends. If you want more breakdowns like this, subscribe. And of course, stay nerdy, my friends.